2nd of March. Thank you. We now come to the programme motion to be moved formally.
I beg to move.
The question is as on the order paper. As many as that opinion say aye.
Aye.
Of the contrary, no. I think the ayes have it. The ayes have it. The clerk will now proceed to read the orders of the day.
Finance Bill, Clauses 1 and 2, Schedule 1, Clause 21, Schedule 12, Clauses 25 and 27, Clauses 31 to 34, Schedule 13, and certain new clauses and new schedules. Committee.
Now.
Order. Under the order of the House of 13th December 2023, we shall now move to Committee of the Whole House. Order.
Finance Bill, Clauses 1 and 2, Schedule 1, Clause 21, Schedule 12, Clauses 25 and 27, Clauses 31 to 34, Schedule 13, and certain new clauses and new schedules.
We will begin with Clause 1 stand part, with which it will be convenient to consider the clauses and schedule and new clauses as on the selection paper. The question is that Clause 1 stand part of the bill. I call the Minister, Mr. Nigel Huddleston.
Thank you very much, Madam Chair. This government's aim is to grow the economy for the good of everyone by removing the barriers to private sector investment and delivering a tax system which is supportive of business. At Spring Budget 2023, the Chancellor set out his approach for a highly competitive tax regime. By announcing a package of generous tax incentives combined with a rate of corporation tax which remains the lowest in the G7, this government has ensured the UK continues to be one of the best places in the world for businesses to grow and invest. And this bill marks our next step in making the UK one of the most competitive tax systems of major economies by enhancing the support the corporation tax system provides to businesses who drive growth by making long-term investments. It meets the government's commitment to introduce permanent full expensing, as announced at the autumn statement, solidifying our international competitiveness and creating the certainty that businesses have told us they need to confidently invest. This bill will also drive UK business innovation by merging the existing R&D expenditure credit scheme and small and medium enterprise scheme. Merging schemes will simplify and improve the system for supporting cutting-edge research and development. Turning first to Clause 1, Madam Chair. At Spring Budget 2023, the Government introduced two new temporary first-year capital allowances for qualifying expenditure on plant or machinery. This included a 100% first-year allowance for so-called main rate expenditure, known as full expensing, which allows companies to write off the full cost of plant and machinery in the year this cost is incurred, as well as a 50% first-year allowance for expenditure on special rate assets such as lighting systems, thermal insulation and long-life assets, allowing companies to write off half the cost of an asset in the year that it is incurred, with the remaining balance written down at 6% in every year afterwards. The Chancellor was clear that long-term his ambition was to make these new reliefs permanent once the fiscal and economic conditions allowed, and at autumn statement he confirmed that he was able to do just that. Madam Chair, Clause 1 delivers this by making both full expensing and the 50% first-year allowance permanent, by removing the end date of the 31st of March 2026. It means that companies will be able to permanently benefit from full expensing. It solidifies our position as joint top of the rankings of OECD countries with regard to plant and machinery capital allowances. And it means we are the only major economy with permanent full expensing. This will give companies the certainty they need to make long-term investments. This responds to calls from the CBI, Make UK, Energy UK and 200 other business groups and leaders, and from companies including BT Openreach, Siemens and Bosch, who have said that making the policy permanent would be the single most transformational thing that the government could do for business investment and growth. According to the OBR, it will generate almost £3 billion of additional business investment each year and £14 billion over the course of the next 5 years. As a result of this, the OBR forecasts that GDP will be 0.1% higher by the end of the forecast period and slightly below 0.2% higher in the long term as a result of this. Certainly.
I'm very grateful to the Minister for giving way, and I absolutely applaud this initiative by the government to make this full expensing permanent. But of course, we know there will be a general election within the next 12 months. Has my honourable friend heard from the opposition about whether or not they, if they were to be in government, would maintain that?
I thank my honourable friend, who's incredibly knowledgeable about this area from his previous business experience and ministerial experience. I think that's a question I'm intrigued to hear answer from the opposition shortly. But I do believe it is vitally important, because the whole point of this is giving businesses the confidence to invest in the long term, and therefore certainty is absolutely key to the investment decisions that are being made.
Further to that point, does he not think, as I do, that it is an aspect of a responsible opposition right now, as we're debating this in this House, to be clear what they would do were they to be in government?
Well, indeed, I think my honourable friend's kicking off what is likely to be a long debate over the course of the next year, but a vitally important one for our constituents and, of course, businesses. The economy will play a pivotal point in the discussions this year. I think it's very clear what we are doing. In fact, we're implementing vital changes asked for by business in response to business to provide that business certainty and the environment in which they can thrive and therefore our constituents can thrive. I don't think any of us want to put that at risk. But, of course, without the clarification and confidence from the opposition about what they might do, of course, those issues are raised and the uncertainty could persist. But from our side, we're absolutely committed, and the honourable member is absolutely right to make that clear.
Can you just confirm, I think he just read out that the assessment is this measure will create £3 billion of additional investment a year. Is that right? Because I think, if I remember the Green Book correctly from the autumn statement, the annual cost of this measure was £11 billion, which I think equates to 55 billion of extra capital expenditure. So is he saying basically 52 of that 55 is just bringing forward investment that would have happened later, and 3 billion is new, or is somehow have I got my numbers wrong and actually this will generate a load of investment that wouldn't otherwise have happened?
The honourable gentleman's right to point out the kind of timing element here, because, of course, with the R&D and the full expensing, I'll come into R&D in a moment, I think that was the 55 billion figure that he mentioned. But these measures, and in particular the full expensing, will, of course, have a long-term impact over a long period of time. So the cost of it is upfronted, but the benefit is, of course, over a very, very long period of time. And anybody who's worked in business understands that. So he's right to point out the anomaly, and actually it's a very important point, because a lot of people probably wouldn't understand it. But the fact that the OBR then have highlighted this incremental impact on the economy overall, I think shows that clearly and transparently there is a net benefit. But the timing of the impact does change. But we are talking about additional investment right away, because, of course, by giving this confidence, businesses will be able to make those decisions and invest immediately. And, of course, permanent... Certainly, yeah.
Thank you, Madam Chair. Grateful for the Minister giving way. I appreciate his comments so far. Would he be able to confirm how many times policy has changed in this important area since 2019? Because whilst he's making some further points today, it does seem that government policy has changed quite erratically, and that in itself is very difficult for businesses to respond to when they're looking for certainty as they plan for the long term.
I agree that certainty for business is absolutely pivotal, but I think in all of these areas, both when it comes to full expensing and R&D, the government and indeed the Chancellor and others have been indicating the direction of travel for some time, and therefore giving it increased certainty. Certainly on full expensing, as I said, it was mentioned a while ago that we intended to pursue this policy when the economic circumstances allow. Now they do so. The R&D, which I'll come on to in a minute, has been discussed for quite a long period of time, and the result of extension extensive cooperation with industry. I think it's also the reality, though, that government policy needs to change in response to the nature of a changing economy, and therefore things like digital and cloud and so on, certainly when it comes to investment, we need to make sure that they are covered by new and emerging policy areas as well. But I think we've seen today, and we've seen in the autumn statement, a very clear direction of travel from this side of the House, and it's about incentivising businesses and cutting taxes. Now, permanent full expensing also simplifies the capital allowances regime overall, as companies can claim the full cost in year one, therefore reducing the need to claim writing down allowances year on year. Madam Chair, turning to Clause 2 and Section 1 now, the Government has also announced the closure of the R&D tax relief review that was launched in 2021, again a point I was just making to the Honourable Gentleman, alongside a set of changes to simplify and improve the system. Clause 2 makes changes to merge the current R&D expenditure credit and SME schemes for expenditure in accounting periods beginning on or after the 1st of April 2024, simplifying the system and providing greater support for UK companies to drive innovation. The merged scheme will have an above-the-line mechanism similar to the R&D expenditure credit with a rate of 20%, and this will make the benefit more visible and easier for companies to factor into their investment decisions. Additionally, small and medium enterprise loss makers will now be able to carry forward their losses rather than having to surrender them, and this will give a total benefit of up to £45 per £100 of R&D expenditure. And there will be a reduction in the rate at which the merged scheme credit is taxed for loss makers from 25% to 19%. So this is worth around £120 million per annum to non-intensive loss makers, and this will increase the upfront cash benefit for loss makers. Subcontracting rules in the merged scheme will allow the company taking the decision to do R&D to claim relief on contracted out R&D. And this is based on the approach in the current SME scheme, identified as the best option in the consultation that we delivered and refined further following engagement with industry over last summer. Subsidy rules will also be removed, allowing SMEs to claim relief for work which they receive a grant or other subsidy, and this represents an increase in generosity of SMEs as well as being a major tax simplification. The Government is also legislating for enhanced support for loss-making R&D intensive SMEs. And that was announced at Spring Budget 2023. And this will benefit 23,000 SMEs per year by providing further support to the most R&D intensive SMEs whilst merging the current schemes. The Government is promoting the conditions for enterprise to succeed. Companies claiming the existing SME tax relief will be eligible for a higher payable credit rate of 14.5% if they meet the definition for R&D intensity. And at the summer statement, the Government announced several improvements being made to this enhanced support. The R&D intensity threshold is being lowered to 30% from 40% from April 2024, meaning around 5,000 more companies will benefit from this support. A one-year grace period is being introduced, providing greater certainty by ensuring companies that dip under the 30% threshold will continue receiving relief for 1 year. The same subcontracting rules as the merged scheme will also apply to this enhanced support, further helping to simplify the system with one set of rules that both SMEs and larger companies will follow. And overall, R&D reliefs will support an estimated £55 billion of business R&D expenditure in 2028-29, a 25% increase from £44 billion in 2021-22. Expenditure on R&D reliefs is forecast to increase in every year of the scorecard period. And will also be restricting nominations and assignments for R&D relief payments. This measure ensures genuine businesses get the payment for their R&D claim directly rather than receiving it through an agent. And this is designed to benefit genuine claimants and reduce non-compliance. And subject to limited exceptions, no R&D tax credit payments will be made to nominee bank accounts, and any R&D tax credit payments must be paid directly to the company who claims for the R&D. So claimants will now receive their payments directly, giving them more control, and this will ensure that the person claiming the relief has better oversight of the claim and will receive the money into their accounts more quickly. Claimants will also be clearer exactly how much money is being charged by their agents rather than just receiving a net amount after fees have been deducted. And this builds on previously announced measures and policy changes to help ensure greater company control over R&D claims. Madam Chair, the Government is committed to making the UK the best place in the world to do business. Full expensing and R&D tax relief support businesses to grow and invest, which will boost productivity and economic growth. This remains the key way to raise everybody's living standards and fund high-quality public services across the UK. I therefore commend Clauses 1 and 2 and Schedule 1 to the committee.
Thank you. James Murray.
Thank you very much, Madam Chair. And I beg to move the new clause in my name and that of my honourable friend, the member for Hampstead and Kilburn. Let me start, Madam Chair, by briefly considering the context in which we're debating Clauses 1 and 2 of the Finance Bill. As we know, this bill follows the Chancellor's statement on November the 22nd last year, in which he claimed he was delivering an autumn statement for growth. As you may remember, Madam Chair, the same day the Office of Budget Responsibility confirmed that growth forecasts had been cut for the coming year by more than half, cut again the year after that, and cut yet again the year after that. Independent analysts confirmed that even after all the changes the government had announced, personal taxes would still be rising. In fact, personal taxes are now set to rise by £1,200 per household by 2028-29, with the tax burden on track to be the highest since the Second World War. And despite people across the country paying so much in tax, public services are collapsing. The NHS is on its knees, whilst more and more families are struggling to make ends meet. That was the context when we last considered this finance bill at its second reading just before Christmas. 13 years of Conservative economic failure that had left people across Britain worse off. The only thing to have changed since then is that we now face 14 years of Conservative economic failure. It may be a new year, but the governing party face the same cold truth that nothing they can say or do now can repair the damage they have done to our economy. Now, Madam Chair, people and businesses across Britain deserve so much better, and as a foundation of better management of the economy, our country needs and deserves stability, certainty, and a long-term plan. It is for that reason that, although we welcome Clause 1 in making full expensing permanent, something we have long been calling for, it simply cannot make up for the years of uncertainty that businesses have faced. Businesses need stability and predictability to help them plan for growth, and their long-term planning has been held back as this government have been chopping and changing business taxes and reliefs year after year, with no evidence of anything resembling a long-term strategy. Yes.
Madam Chairman, and thank you to the Shadow Minister for giving way. And I was very pleased to hear him say that the opposition welcome the full expensing, and that might help clarify. Maybe he can just go further too, because new clause 6 in his name does say that the opposition want to have a review of all business taxes and reliefs, which in its ambit would include full expensing. And he will know, and the honourable member behind him, the member from Mid-Bedfordshire will know, there's a particular investment decision that's a potential investment decision in our county. Could the Shadow Minister just again make explicit that it is the intention that for the Labour Party in the next election, their manifesto will include a commitment to maintain full expensing?
Well, thank you, Madam Chair. And, I thank the honourable gentleman for raising that point. And as I've said, we've long been calling for full expensing, and we welcome the fact it's today being made permanent. But without seeming too jokey in my response, Madam Deputy Speaker, I'm deadly serious when I say if he wants to know in all seriousness what a Labour government would do if we got into office, there is one way to see whether that eventuality comes about, which is to have a general election sooner rather than later, rather than drag it on throughout the course of 2024. Because, frankly, we need to move on as a country from the current government, Madam Chair. Just look at the government's record when it comes to capital allowances since the last general election. The honourable gentleman spoke about certainty and the need for stability. But as I mentioned at the second reading of this bill, Madam Deputy Speaker, let's look at the changes that have happened to capital allowances over the last 4 or 5 years. Back at the beginning of this Parliament, the annual investment allowance had been raised to £1 million on a temporary basis. That temporary basis was extended by the Finance Act 2021. It was extended again by the Finance Act 2022. It was then made permanent by the Finance No. 2 Act 2023. Meanwhile, over the course of this Parliament, the super deduction came and went entirely. Last year, full expensing, as we know, on expenditure for plant and machinery was introduced, but only on a temporary basis for 3 years. And now, of course, Treasury ministers are amending what their predecessors announced only last year by making full expensing permanent. And so whilst we welcome that fact, I wonder quite how long this policy will last. Frankly, I wonder how long any policy can be expected to last under this government when it is led, in the loosest possible sense of that word, by such a weak Prime Minister. But, Madam Chair, if we accept Clause 1 at face value, we welcome its principle of making full expensing permanent, as this is something, as I said, we have long been calling for, and I will focus the rest of my questions on some specifics of the government's approach. As ever, I am grateful to the excellent team at the Chartered Institute for Taxation for all of their thoughts on the detail of what the government has proposed in this clause and indeed in others within this bill. And I know that one matter of interest to the Chartered Institute was the fact that at the autumn statement, the government said it would be publishing a technical consultation on leased assets. I'd be grateful if the Minister could tell us when this will be published. Furthermore, both the Chartered Institute and the Association of Taxation Technicians, to whom I'm also very grateful for their thoughts on the detail of this bill, have queried which companies and assets are eligible for full expensing. So I'd be grateful if, when the Minister responds, he could clarify which assets are outside of the scope of full expensing and whether the Department will be publishing a detailed list of what counts as plant and machinery and what does not. I'd also be grateful if the Minister could tell us how many firms will not be eligible for full expensing because they are partnerships. I know that many who take an interest in this matter would welcome their clarity on that. Madam Chair, I'll move on to Clause 2, where the Government is proposing changes to the system of tax credits for research and development. As with their approach to business taxation and capital allowances, the Government has failed to deliver any sense of stability when it comes to R&D tax credits, despite certainty and predictability being so crucial to businesses making investment decisions. That much is very clear by looking at the list of changes we have debated in finance bills over the course of the current Parliament alone. We had the Finance Act 2020, which changed the rate of R&D expenditure credit. Then the Finance Act 2021 changed how much R&D tax relief small and medium enterprises could claim. Finance Act 2023 again changed the rates of R&D tax relief. Finance No. 2 Act 2023 changed further how the relief operates, and now the finance bill before us changes the system of release yet again. Now, we accept, of course, that some change is necessary and important to enable legislation to function well, but this simply does not seem to be what we have seen. What we have seen is a government incapable of providing stability, predictability and a long-term plan that businesses need to invest and grow. And it is clear that after 14 years in office, the Conservatives are incapable of providing that crucial foundation for our economic success.
Well, my honourable friend could weigh on that.
Yes, indeed.
Thank you, Madam Chair. My honourable friend is making an excellent point, which actually is coming to the nub of the argument here, really, that the government is not capable of providing business with the certainty that it needs, which is such a tragedy because so many emerging wonderful industries which have got incredible potential in the UK need that certainty, as indeed do other businesses.
I thank my honourable friend for his intervention. He's absolutely right that so many businesses in the UK who are keen to invest and grow and make people across Britain better off are being held back by the lack of stability and certainty from this government. And I can't help but notice, Madam Chair, that the government indeed recognise the symptoms of the problem, that a lack of stability and certainty is indeed a problem for economic growth. It just seems they're simply unable to provide a response to that and provide the long-term plan that Britain so desperately needs. And we know, Madam Deputy Speaker, that with so much chopping and changing without any clear long-term plan, it's had a cost on our economy by undermining prospects for investment, innovation and growth. Indeed, the ICAEW has shared with us the view from their members that there is a lack of confidence when claiming R&D tax relief within the UK, and their belief that, and I quote, "This has arisen due to the various changes made to the rules in quick succession over the past few years." We also know, of course, that having so many changes, one after the other, has a direct impact on taxpayers as well as businesses too, as the public finances bear the costs for all the impacts on HMRC in terms of IT systems and staffing. Now, our analysis of HMRC policy papers suggests that the changes made and proposed within the current Parliament have had a cumulative impact on operational costs for HMRC of more than £60 million. That sum is likely to include a substantial waste of taxpayer money as a result of so many piecemeal changes being made rather than a coherent and lasting reform. And that is why, to be clear and transparent on the costs of all the government changes to R&D tax credits, we have tabled new Clause 1. This new clause would require the Chancellor to publish a review setting out the total implementation costs of all changes to research and development release in the current Parliament. I hope the Ministers will accept this straightforward new clause, but if not, I would look forward to members opposite who would be interested in such transparency joining us in supporting it. Furthermore, if ministers are not prepared to vote for it themselves or accept it in this debate, I would be grateful if they could at least commit to writing to me with the figures that our new clause requests. Now, Madam Chair, in terms of the substantive impact of Clause 2, we should be clear on what it in fact does. At the autumn statement, the Chancellor said the government was, and I quote, creating a new simplified R&D tax relief that combines the existing R&D expenditure credit and small and medium enterprise schemes. We heard similar words from the Minister in his remarks earlier in this debate. In reality, though, the government's plans still effectively maintain two separate schemes. Although they seek to merge the two existing schemes, they continue to provide additional support for R&D intensive SMEs through the existing SME scheme, rather than it forming part of the new merged scheme. Although we recognise that R&D intensive SMEs may need extra support, as the Chartered Institute of Taxation have pointed out, the government's plans are, and I quote, less a merger than a shifting of most SMEs into a revised scheme based on an RDEC approach, with the same SME scheme remaining for a smaller group of R&D intensive SMEs. The Association of Taxation Technicians have pointed out the impact this may have, saying that, and again I quote, the introduction of new rules to define R&D intensive SMEs and the possibility of companies moving in and out of the two regimes as their expenditure profile changes will arguably result in an overall increase in the complexity of the R&D relief scheme rather than a simplification. Now, as I said, we recognise that R&D intensive SMEs may need additional support, but I would be grateful if the Minister could explain why the government have chosen to continue operating a separate scheme to provide that support, rather than delivering it as part of the new merged scheme. Alongside understanding the government's attention over the design of the new regime, I would also like to question the Minister about the timescales for the measures in Clause 2 being implemented. In the policy documents associated with the autumn statement, it was clear the new regime would apply from April 2024 onward. In the legislation before us, however, Schedule 1, which Clause 2 introduces, makes clear that the changes will apply from an appointed day, a day to be appointed by the Treasury in regulations. I'd be grateful if the Minister could confirm in their reply what that appointed date is. Is it April the 1st, 2024, or is it going to be a later date? As April is less than 3 months away, if the appointed date does indeed fall within that month, can the Minister confirm whether they are confident that that leaves enough time for proper consultation and for any new systems and processes to be put in place by businesses, agents, software providers and HMRC? If instead the appointed day is going to be later than April 2024, then those affected need to know what is happening. I hope the Minister will be able to provide clarity on this today. Otherwise, sadly, this seems to be yet another example of continued uncertainty for businesses from this government. Now, finally, Madam Chair, we know that the government is concerned about the level of non-compliance with the R&D tax credit schemes. In their policy paper published in November about the merging of the current schemes, they wrote that further action may be needed to reduce the unacceptably high levels of non-compliance in the R&D reliefs, and HMRC will be publishing a compliance action plan in due course. Tackling non-compliance is, of course, very important, and so I'd therefore be grateful if the Minister could confirm in their reply when HMRC will be publishing the promised compliance action plan. I'm also very aware from meetings I have had with smaller businesses that they often face a great deal of confusion over the guidelines associated with R&D tax credits. Whereas larger businesses will typically have the resources and institutional capacity to navigate these rules, I am concerned that smaller businesses often do not, and may find themselves having to pay for expensive consultants to help them understand them. This is where HMRC could have a role to play in supporting small firms with clarity about the guidelines on R&D tax credits, as well, of course, as its role in tackling genuine fraud. Indeed, the Startup Coalition, an organisation that advocates for policies to support innovative firms in the UK, have highlighted the need for HMRC to improve, and they have called for improved transparency around adjudicating whether activity is R&D to provide certainty for firms. The ICAEW makes similar points, stressing the need for guidance and education, making clear that, and I quote, the new rules will significantly affect all sizes of companies, including those smaller entities with limited professional tax resource. I would therefore urge the Minister to make sure any plan for improving compliance with the rules also focuses on making the rules easier to comply with wherever possible, and working with small, innovative firms to help give them the certainty they need to thrive. Madam Chair, to conclude, we will not be opposing either of these two clauses in this debate, but I would urge Treasury Ministers to accept our new Clause 1 and to respond in their reply to the specific points I have raised. More widely, it is clear from their approach to capital allowances and to R&D tax release that the Conservatives are incapable of providing stability and a long-term approach. Their failure is letting down businesses across our country who stand ready to play their part in growing the economy and making people across Britain better off.
Hear, hear.
Maggie Throup.
Thank you, Madam Chair. I'm delighted to be able to speak at this committee stage of the Finance Bill, which I really do believe emphasises the Conservative principles of encouraging entrepreneurs, free enterprise and innovation. Many in this chamber will know that I don't have a traditional finance background, but I did run my own business for 19 years. So I think that does qualify me to be able to identify when fiscal measures are really going to help business. And that's what I see, especially in clauses 1 and 2, which I'm going to speak to today. So I want to first of all take the opportunity to speak in favour of clause 1 of the bill, which will support the UK business by making full expensing permanent. At the Spring Budget 2023, the Chancellor introduced major reforms to the system of capital allowance by replacing the super deduction system with 3 years of full expensing. This new measure, which initially was put in place until the 1st of April 2026, allows companies to claim the full cost of their expenditure on plant or machinery against tax when the business investment is made. This measure was well received by businesses across the UK, as my honourable friend the Minister has already stated, and how he also quoted a number of large PLCs. But it also has allowed a number of Erewash-based businesses to benefit and to prosper. Dales Fabrications Limited had previously claimed super deductions, that's the predecessor to the full expensing, on a very significant piece of machinery. And this sounds quite complicated to me, but it was a 4-metre brake press with lots of bespoke options. And the benefits of super deductions were of such significance that the business purchased additional and highly beneficial tooling concurrently with the machine itself. The now chairman of the business said to me, and I quote, "In reality, we would have inevitably deferred that additional tooling purchase without the super deduction, thus meaning we wouldn't have had the 100% of the benefits of our new machinery from day one, and would have been effectively denied access to some types of work that went beyond typical industry standard sizes." The owner of another business, Militech, said, and once again I quote, "Super deductions are really good and a real incentive for us to invest." So I think the successor to super deductions, and that's being able to fully expense the cost of plant and machinery on a permanent basis, as proposed in the clause 1 of this bill, will undoubtedly continue to be a huge incentive for businesses across the UK to invest in their futures and in UK PLC. I know by speaking to my local businesses that they do really welcome it, and they just see it as one way to be able to expand and grow their business. But I do have a question for my honourable friend the Minister. The terminology plant and machinery is very broad. So when he responds, could he provide some clarity for my Erewash businesses as to what is defined by plant and machinery to help them understand what is in scope? So, for example, does it extend to IT equipment? Because I think by having a better understanding of the terminology, it will really help businesses of all sizes take full advantage of what's on offer here. But the contents of Clause 1 does show that the government is on the side of business. Ahead of the autumn statement last year, 200 businesses, including AstraZeneca, that are so instrumental in the COVID vaccine rollout, and Toyota, a major employee for many of my constituents, wrote a joint letter to my honourable friend, the Chancellor, asking for the 1st of April 2026 expiry date to be removed, making full expense permanent. And today, by supporting Clause 1 of this bill and making full expensing permanent, we are backing businesses and helping them to succeed. But it also shows that government is listening to business and making sure that they're putting in place measures that will really help them grow their business. So Clause 1 will provide businesses with the biggest tax cut in modern history, worth over £10 billion a year, making the UK capital allowances regime one of the most generous in the world. And since the introduction of temporary full expensing in April 2023, the UK has become an appealing place to invest. The UK has had the second highest investment growth in the G7 and 3 times that of the US. Making full expensing permanent can only perpetuate that growth. So before moving on to the next clause, I would ask my honourable friend when he winds up whether plans are in place to extend full expensing to plant and machinery that is either leased or hired. Because these two options are so often the only affordable options for businesses with big ambition but limited capital. So let me now turn to Clause 2 and Schedule 1, Madam Chair. This will simplify research and development rules by merging the small or medium enterprise and the R&D expenditure credit schemes. Whether it's trialling and distributing the successful COVID vaccines, which helped us defeat COVID-19, to testing and developing new innovations that will enable us to meet our net zero targets, R&D businesses play a vital role in growing our economy. At the Spring Budget 2023, my right honourable friend the Chancellor announced enhanced support for R&D intensive SMEs, worth around £500 million per year, consulted on the potential merged R&D tax relief scheme and supporting those loss-making R&D businesses. As a result, measures in this bill shows the government's unwavering support for R&D and businesses. Specifically, Clause 2 and Schedule 1 will help reduce bureaucracy and ensure that taxpayers' money is spent as effectively as possible by simplifying the R&D tax system. It will stop many businesses having to navigate the complex transition between the two existing schemes. It is anticipated that the intensity threshold in the R&D intensive schemes reduction from 40% to 30% from April this year will allow around 5,000 extra SMEs to qualify for an enhanced rate of relief. A one-year grace period will also be introduced, providing certainty for companies who dip under that 30% threshold that they will continue to receive relief for 1 year. This is a vital measure for so many R&D focused businesses which inherently have peaks and troughs of activity. Taken together, these changes will provide £280 million of additional relief per year by 2028-2029 to help drive innovation in the UK. As a former biomedical scientist and someone who continues to take a keen interest in the area, there are measures announced in Clause 2, Schedule 1 of this bill, which will undoubtedly benefit the bioscience sector. The government is adopting an interesting position on subcontracting. This clause will allow the decision maker to claim for subcontracted R&D work. And can the Minister confirm that subsection 3 of new section 1133 will enable a company that is contracted to do work which is not research and development, and then they decide to carry out some related R&D, that they will, as a result of this bill, be entitled to claim relief for it? And will he also confirm that the new measures will allow a business that contracts out qualifying activities to a contract research organisation, such as a clinical trial, the company will be able to claim for the cost of that contract? If this is the case, I'm sure that R&D subcontracting will increase collaboration and knowledge sharing, which are crucial for economic growth. I have no doubt that the measures announced in this finance bill will be the ignition that accelerates the UK's economy and leads us to a brighter future. I'll be supporting the bill throughout its passage today.
SNP spokesman Drew Hendry.
Thank you, Madam Chair. I'm only going to make some brief remarks on these two clauses. The UK government's clearly scrambling to fix an economic mess of its own making, and this bill is full of such measures. For Clause 1, during the autumn statement, I welcomed this move, but it does little to deal with the damage to business that has been caused by the big grey elephant in the room, Madam Chair, which none of these parties wish to mention, which is Brexit, which is far from the ideal of removing red tape and decreasing bureaucracy, as we've heard thrown about this chamber, has actually led to more red tape and more difficulties for business. So this is just one measure that this government should be taking amongst many others that it must consider in the future, and later in the debate I will hope to come to those. The years of uncertainty that the Labour front mentioned have indeed been years of uncertainty caused by this government, but they've definitely been impacted by that Brexit that they now support along with the Liberal Democrats. People are struggling with a cost of living crisis, and this is affecting domestic sales too, so they need other fixes, and again I'll come to some questions about those later today. For Clause 2 and Schedule 1, this is for the Minister, and hopefully be helpful, like trying to make a jigsaw puzzle with no box, no picture, and just some random bits and pieces to try and plug together to make something out of it. Productivity, of course, doesn't work without the skills required in research and development. We don't get the kind of advance, the kind of boost that we need without that. And of course, once again, that spectre of Brexit has meant that we have a skill shortage across the nations of the UK, affecting Scotland in particular, which needs its own immigration rules. And again, it's something that we would ask for the powers over, short of our call, which of course would be the absolute best result, which is for Scotland to have independence so it can make these decisions itself. Thank you.
Nigel Mills.
Thank you, and it's a pleasure to speak in this debate, and I want to direct my remarks to Clause 1 of the bill, the permanent full expensing for purchase of plant and machinery, which I think, discussed in the autumn statement and second reading in this bill, because this is actually quite a radical and expensive policy. We have, for probably longer than all our lifetimes, given companies relief for capital expenditure using capital allowances, and what was originally actually quite a generous 25% in the first year, because most plant and machinery had a longer life than that, I suspect, when we were producing these rules. And we've chosen to do that for all those years, rather than just letting a business deduct its own accounting calculation of depreciation, because we didn't want to have manipulation of tax deductions by businesses doing their tax returns. We've chosen to do it this way. And the tool that businesses of all colours for decades have had when the economy hits trouble is to give first-year allowances of various enhancements. I remember a 40% first-year allowance, like I remember a 50% first-year allowance. We've had full expensing up to £1 million, as the Shadow Minister referred to. I mean, this has been the way of incentivising investment in a period of economic recovery for as long back as there's probably been a toolkit on this. And now we've landed on permanent full expensing, so you get full relief for any plant and machinery spend in the first year. And what I'd just like to ask the government is, what are they expecting to happen differently here? Are we expecting capital investment by businesses of over £1 million a year to be taking place that otherwise wouldn't be economically viable and would never have taken place? Are we expecting investment to be brought forward and take place earlier than it would otherwise have done, which is entirely welcome? It probably modernises that businesses, protects jobs, gives them a chance to grow in a way they perhaps wouldn't otherwise have had. So that's not a bad policy aim at all. Or are we just giving businesses an earlier tax relief they would otherwise have had, and they'll just bank that and be quite happy, but it won't change behaviour? Because it's quite hard to get behind the numbers in the Green Book on this, which, as I quoted earlier, the actual estimate for the end of the 5-year period, I think probably the first full year that this making permanent will make a difference, is a tax cost of 10.9 billion just for this measure, Now, bearing in mind the business would already have got 25% tax relief on that same expenditure in that year, if you run the numbers, that means we expect 55 billion higher claim to get tax relief in that financial year than would otherwise have happened. Yet the Minister quoted that only 3 billion of that is estimated by the OBR to be additional investment that wouldn't otherwise have taken place at some point, which kind of suggests we've got a lot of stuff being brought forward, or we've just got a lot of more generous tax relief investment that would have happened anyway. So perhaps the Minister could just explain what the government is aiming to achieve and what the government is forecasting, and whether perhaps the OBR is just being unduly cautious here. Because I think it would actually enable us to understand how we judge whether this measure has been successful or not. Are we expecting to see whole loads of investment in plant machinery that would never have been viable before, or are we expecting to see it brought forward? But if what we're getting is brought forward, at some time the cost of this should start to taper down, because this isn't a new tax relief people wouldn't already have had. It's just an acceleration of tax relief, and you'll pay more tax in all subsequent years because you're not getting the relief that you used to get. So you think the measure would cost 11 billion in the first year, and you gradually that would level down in the fullness of time. There'll be no more annual cost to this, in effect. Hopefully the Minister could just start that, because it's not immediately clear how the government planned to assess whether this measure has worked or is working. I assume from electronic corporate tax returns we can actually track down to the pound the amount of investment that's claimed for a full expense relief every year. So we could actually have a report, within 6 months of the end of a calendar year on actually how much of these 100% allowances have been claimed, and we can compare that with the total amount claimed for capital allowances in the preceding number of years we like, and we could see whether this actual full expensing was driving the behaviour change we want. So perhaps the Minister could just talk us through what he expects to happen and how he's going to assess whether this has actually been an effective way of boosting productivity and increasing investment for what is £11 billion a year. It's probably one of the most sizable line entries we've seen in a finance bill in my 14 years here. I mean, normally you expect the big number to be a tax cut for individuals. This is actually quite a significant situation in that. Now, as we've made this a permanent feature of our tax system, I think it really does shine a light on actually what are we trying to get our corporation tax system to do, because this actually won't be any kind of compliance saving. And I think the Minister had a brave attempt at saying it might be, but effectively all that will change is the number that a business currently puts in its additions to its writing down allowance pool. They'll now put in the 100% first year claim box. So it's the same number, different box. That's the only compliance change that you have here. But it throws into question, I think, some previous policy decisions that we've made, because actually for a business to get full benefit of this, they need to be paying enough tax to be able to use the full relief in that first year. If they can't use the full relief, then the incentives aren't as powerful as they would otherwise be, because then their option is to effectively carry that excess deduction forward. But we introduced rules a few years ago which restrict how many losses you can use in a year. So if we really think that giving people the earliest possible cash tax benefit for capital investment drives investment, we should probably take away that restriction on using losses. Businesses can actually get the cash benefit as early as they possibly can and not have it spread over a number of years going forward. So perhaps the Minister could just explain whether the government will look at that and just make sure we're not accidentally undoing some of the benefit that we're seeking to get here. The second question I've got is, what do we do with the legacy writing down allowance pool that relates to plant and machinery expenditure for God knows how many past years? Because actually, on a reducing balance basis of 25%, it takes many, many years to get full tax relief for expenditure. So every business will have a large pot of money that it's not yet had tax benefit for. Are we expecting them just to run that down at 25% reducing balance a year and still be doing this in 23 years' time, by which time no one will have any idea what on earth that balance ever was? Or should we look at saying, well, actually, that's a bit of a nonsense, isn't it? Why don't we just let you take the whole balance at 20% a year over the next 5 years and finish that problem off, because we don't really need to be focusing on that. I'm sure you could find any number you like there, but it would actually just draw a line under that past expenditure in a way that I think then does genuinely simplify things. We then do have the question of, what do we do then with capital expenditure on items that aren't plant and machinery? Now, actually, we're not very generous on structures and and buildings in terms of the tax relief we give. But if what I'm trying to drive here is increasing productivity and large businesses to invest in new gigafactories to build batteries for electric cars or for electricity storage or whatever, don't we want to incentivise them to build the factory building as well, rather than either give them no relief or give them over a very long period of time? So should we actually be, if we're going to be spending £11 billion a year to encourage this investment, shouldn't we be spending a little bit of money trying to encourage other things that are key for that industrial investment to actually take place as well, and try and be a bit more generous on buildings and structures in that position? So particularly the Minister could just explain whether he has any thoughts. Now, I know the government did a capital allowances review only a year or two ago, which actually didn't look at permanent full expensing as one of the options. But it'd be interesting to see whether they've had any further thoughts on that, because actually, what we are now in a position is we're asking every business to go through and track every item of capital that they spend and treat it differently in their tax return to how they treat it in their accounting records. And then we've got all manner of different rules, whether it's a long life asset, a short life asset, a car, an environmentally friendly car. You can go on with all this sort of stuff. For the amount that's now at stake, given we've given full relief for plant and machinery, that is the biggest amount of this, do we really need all that cost and complexity? Or should we just say, for all those other items, you can just have your accounting calculation, and okay, they may take it a bit quicker than we like, but in actual fact the cost of that's not really all that material in the scheme of things. And so we could move to a system where the only adjustment you have to make in your tax return is to claim a very generous tax relief on plant and machinery, and you wouldn't have to touch anything else. I think that would actually, be a more coherent corporation tax regime. Now we've spent all this money incentivising plant and machinery, and actually would then genuinely be a compliance saving for business in that situation. So I support this. I truly hope it works, but it is a significant amount to spend. I think it would be helpful just to understand what we're trying to achieve, how we know whether we've been successful, and I hope the government will now move on to think actually how we can slightly recast our tax system so it makes sense, having made this really quite radical and generous change.
Minister.
Thank you very much, Madam Chair, and let me thank honourable members for their contributions today. I'll take a few moments to respond to actually quite a few questions raised during the debate. I think probably first and foremost I should reassure members that further guidance will be provided on these schemes because of course we don't want all these schemes just to exist. We want them to be used because then it'll have a real world impact. So more information will be coming out on a variety of areas over a period of times. But I should gently remind the honourable gentleman opposite, who yet again took the opportunity to talk the UK economy down, as the opposition always do, that every single Labour government has ended with unemployment higher than it was when they inherited it from the Conservatives. That is a pattern that I think the public are well aware of. I'll answer many questions now that were raised, and I thank honourable members, the honourable member for Amber Valley, Erewash, and indeed opposition members for their contributions. In terms of timing, the government has been clear, actually, since the merged scheme consultation was published in January last year, that the intended implementation for a date for this scheme is April 2024. But the merged scheme, importantly, in response to that consultation and recognition to comments, will apply to accounting periods starting on or after the 1st of April 2024, rather than to expenditure incurred from that date. And again, we'll be providing further guidance there. On an issue raised by the member for Erewash and Ealing North on leasing and hiring, again at spring budget, the government committed to engaging with stakeholders on this point with a view to extending the scope of expensing to include assets for leasing and hiring. The autumn statement confirmed it will be continuing to consider this issue, and we will be launching a technical consultation on draft legislation shortly in early 2024. Several honourable members asked what specifically will be included. I have a whole list of what is defined by plant and machinery. It's a perfectly valid and important point, and as I say, I do want to reassure honourable members that further guidance will be provided. But indeed, plant and machinery does include things such as computers, printers, office equipment, vehicles, vans, lorries, tractors, forklift trucks, tools, ladders, drills, equipment such as excavators, compactors and bulldozers and so on. So quite a comprehensive list, but more information will be provided. The Honourable Member for Amber Valley raised the important point of buildings, and of course, while not included in full expensing, businesses can instead receive relief through the separate structures and building allowance that the government introduced in 2018. On the matter of fraud raised by the honourable member opposite, of course, over the last 3 years, HMRC significantly increased the number of people working on R&D compliance to over 500 people. We've also announced policy measures to counter non-compliance in R&D schemes, and we'll be following up with more detailed compliance action plan outlining how HMRC will reduce error and fraud, and that will be published in due course.
It actually follows on from the comments from the member for Amber Valley in relation to the impact of these schemes. So I wonder, following on from the Federation of Small Businesses request that there would be some publication of the actual impact of R&D levels on tax through these tax reliefs. And also I wondered if you would publish a report on the impact on different regions and sub-regions of these reliefs.
Yes, of course. All taxes are kept under review, as are the impact on taxes, which is why some of the calls for further analysis is not necessarily necessary, because we do this as a matter of course. I think it's really important to stress, though, that, for example, many external studies have found that full expensing, when introduced in other countries, has been very effective in supporting investment. And, of course, the OBR forecast, forensic OBR forecasts, predict a boost of £3 billion each year. And in terms of the analysis and impact already from the super deduction, the analysis is taking place, but companies have 12 months from the end of their accounting periods to amend their tax return, and that means that HMRC won't have complete data on the impact of the super deduction until 2024, but we will be providing that further analysis, of course, in due course. The Honourable Member for Erewash mentioned a whole range of real-world impacts of these measures and the previous measures, including the super deduction, and, of course, very importantly, the annual investment allowance at £1 million, which affects the 99% of smaller businesses that can effectively benefit from full expensing, because what we announced, obviously, in the autumn statement is the full expensing for the larger businesses, that top 1%, that actually participate or conduct about 80% of full investment. And I'm aware of time, Madam Speaker, but just a couple of other key points raised. The Honourable Member for Erewash raised the point of subcontracting. Again, we've extensively engaged with stakeholders over this issue over the summer, and the government's developed an approach that will allow the person taking the decision to do R&D to claim that relief. This was the preferred result of the consultation, but an exception will apply in the important area she mentioned for companies doing R&D, such as in a clinical trial in the UK for another company that is ineligible for relief, for example, because it's an overseas customer. So that's to make sure that the impact is there for everybody to benefit. The Honourable Member for Ealing North also mentioned about in terms of partnerships, a corporate partner is eligible for full expensing. An unincorporated partner is not eligible, though. But again, the annual investment allowance of £1 million covers the investment needs of almost all unincorporated partnerships. The Honourable Member opposite also, as he keeps harping on about, keeps saying taxes are rising. I strongly advise that he looks at his payslip, compares the December payslip to the one that he'll be getting shortly. And maybe he would do the decency of coming to me and telling me whether his tax paid is lower or higher. At each fiscal event needs to be taken separately. At the last fiscal event, at the autumn statement, we cut taxes. National insurance is down by 2p. If the Honourable Member doesn't believe me, then I'll do this challenge with him. If his pay slip shows that his taxes are lower, maybe he'll do the courtesy of coming to me and apologising if it is lower, and or giving the difference in money to a charity so that he can actually put his money where his mouth is on this issue. In terms of new clauses, as I said, we don't believe it's necessary because the information has already been published in the tax impact and information notes alongside each change. So these give a clear explanation of the policy objectives, along with details of the implementation costs for both HMRC and businesses, and therefore the new clause is not necessary. I therefore urge the House to reject new clauses and beg to move that clauses 1 and 2 in Schedule 1 stand part of the bill.
The question is that Clause 1 stand part of the bill. As many as are of that opinion say aye. Aye. Contrary, no. I think the ayes have it, the ayes have it. With the leave of the House, I shall put together the questions on Clause 2 stand part and that Schedule 1 be the first schedule to the bill. The question is that new Clause 2 stand part of the bill and schedule for... that Clause 2 stand part of the bill and that Schedule 1 be the first schedule to the bill. As many as are of that opinion say aye. Aye. The contrary, no. And I think the ayes have it, the ayes have it. New Clause 1 has been selected for separate decision. James Murray to move new Clause 1 formally.
Move formally.
Review of reliefs for research and development.
The question is that new Clause 1 be read a second time. As many as are of that opinion say aye. Aye. The contrary, no. No. Division, clear the lobby. The question is that new Clause 1 be read a second time. As many as are of that opinion say aye.
Aye.
No.
No.
Country, no.
No.
Tellers for the ayes, Andrew Weston and Mary Glindon. Tellers for the noes, Mike Wood and Suzanne Webb. Order. Order.
The ayes to the right, 224. The noes to the left, 294.
Thank you. The ayes to the right, 224. The noes to the left, 294. So the noes have it. The noes have it. Unlocked. We now come to Group 2, and we will begin with Clause 21 Stand Part, with which it will be convenient to consider the clauses and schedules and new clauses as on the selection paper. The question is that Clause 21 stand part of the bill, and I call the Minister, Gareth Davies.
Well, Madam Chair, with permission, I'd like to introduce clauses 21, 31 to 34 and schedules 12 and 13 for debate. These cover technical changes to Pillar 2 of the International Tax Agreement, doubling the maximum sentence for the most egregious forms of tax fraud, the introduction of new powers to tackle the promotion of tax avoidance, and action against fraud in the construction industry scheme. Madam Chair, the UK's tax gap is currently at an all-time low, at 4.8% of the total tax liabilities. This has been due to strong government action to tackle all forms of non-compliance in the tax system. But we're never complacent, which is why we've introduced over 200 measures since 2010, including 40 since 2021, to reduce the tax gap even further. This government is taking action to ensure individuals and companies pay the taxes that are due in the UK. We want to deter individuals from committing fraud in the first place, which is why we're doubling the maximum sentence for tax fraud as an example. The government is also taking further action against tax avoidance by introducing a new criminal offence on the promotion of tax avoidance and by expediting the disqualification of directors of companies that promote tax avoidance. These measures are designed to protect tax revenues, which are also very important for funding our vital public services. It's also important to protect tax revenues from companies shifting profits offshore. That's why the UK has implemented Pillar 2 on the 31st of December 2023 and why we're updating the existing legislation with technical amendments today to ensure that the UK legislation is consistent with newly agreed guidance, address further stakeholder comments to clarify terms and to avoid unintended consequences. Madam Chair, Clause 31 strengthens our powers of enforcement when it comes to tax offences. It doubles the maximum prison term from 7 years to 14 years for individuals convicted of the very most egregious cases of tax fraud. This applies to all taxes and duties administered by HMRC. It also increases the maximum penalty for counterfeiting from 10 to 14 years. These measures demonstrate, I hope, the government's intent to crack down on tax fraud and deter criminal actions which damage the public purse. Madam Chair, moving to clauses 32 and 33 and Schedule 13, these seek to target the promotion of tax avoidance in order to protect the taxpayers, as I've said, and reduce the damage inflicted on public finance from tax avoidance. And recent powers, such as the ability for HMRC to name promoters and their schemes and to issue stop notices, are effectively disrupting promoters' activities. Nonetheless, there remain a small number of promoters who persist in attempting to sidestep the rules. And so Clause 32 and Schedule 13 enable HMRC to act swiftly to seek disqualification of directors and other individuals who control or exercise influence over companies involved in the promotion of tax avoidance. They now enable the removal of these individuals from the avoidance market and deter others from becoming directors of companies promoting avoidance. Madam Chair, in the Finance Act 2021, the government introduced rules that allow HMRC to issue stop notices, which require promoters to stop promoting specified tax avoidance schemes. They're an important deterrent tool, as a failure to comply with a stop notice can lead to a substantial civil penalty. Clause 33 increases the consequences for failing to comply by introducing a new criminal offence, which would apply to promoters of tax avoidance who continue to promote an avoidance scheme after already receiving a stop notice. Creating a criminal offence signals the severity of this issue and reinforces the importance of complying with a stop notice. Finally, Madam Chair, Clause 34 tackles serious non-compliance in the construction industry. This scheme relevant to the industry requires contractors to withhold tax unless subcontractors hold gross payment status. Most gross payment status holders are legitimate and compliant construction businesses, but in recent years, gross payment status has been used by organised crime organisations to facilitate fraud. This allows unscrupulous actors to compete unfairly against legitimate businesses. Clause 34 therefore strengthens the tests for gross payment status by adding VAT to the taxes subcontractors must demonstrate compliance with. And this measure is predicted to raise around £300 million over the next 5 years. So, Madam Chair, each of these clauses help to protect vital tax revenue used to fund our public services. They seek to deter taxpayers from knowingly defrauding the government and to encourage them to act against the promotion of tax avoidance. I therefore ask that clauses 21, 31 to 34 and schedules 12 and 13 stand part of the bill.
Shadow Minister James Murray.
Thank you very much, Madam Chair, and I beg to move the new clauses in my name and that of my honourable friend, the member for Hampstead and Kilburn. I will start by considering Clause 21 and Schedule 12, which relate to the implementation of Pillar 2 of the OECD G20 Inclusive Framework on Base Erosion and Profit Shifting. Now, we on this side of the House support this clause and schedule, as they are intended to modify the existing multinational top-up tax and domestic top-up tax introduced in the Finance No. 2 Act 2023 to make sure these new taxes work as intended. We have long supported the global deal on the taxation of large multinationals, as we want to see it working effectively as possible. We know that the OECD guidance on implementing the deal is coming out in tranches, and so it will be important for the UK legislation to be updated to reflect that. We recognise that, as with any global deal of this scale, its details are complicated and its implementation will take time. Yet we have been clear throughout its development that we support the principle of a global agreement as a crucial step in making the tax system fairer, helping to make sure British businesses who pay their fair share of taxes are not undermined. Indeed, Madam Chair, nearly 3 years ago, in April 2021, I first set out in the Commons our support for a global deal to make that tax system fairer, to make sure the level playing field is there for British businesses, and to stop the international race to the bottom for large multinationals. The Treasury ministers at the time, though, appeared to be at first lukewarm in backing plans emerging from the US from the global deal. Eventually, however, the then Chancellor, now Prime Minister, began to support the deal in public. We were glad that the current Prime Minister seemed to have come round, but I'm not sure all of his backbenchers have. I wonder if those on the opposite benches, I noticed the Honourable Member for North East Bedfordshire, for instance, would agree with the Prime Minister when he said, "We now have a clear path to a fairer tax system where large global players pay their fair share wherever they do business." We actually agree with the Prime Minister on that point. I just wonder if everyone on his own benches do. I'm reading some of their faces, Madam Chair, and I think the answer is clear. Could it be the case that the Prime Minister lacks support on a policy he is now championing from prominent backbenchers within his own party? Surely not. No. But Treasury ministers should rest assured that if their backbenchers pull any tricks on Clause 21, they will have our support for it to pass. Now, of course, Madam Chair, this clause relates to Pillar 2 of the OECD deal, which seeks to make sure large multinationals pay a minimum rate of 15% corporate tax in every country in which they operate. There is, of course, also Pillar 1, which involves partially reallocating taxing rights over the profits of large multinationals to the jurisdictions where consumers are located. Whilst we know that the implementation of Pillar 2 is going ahead, as indeed this finance bill makes clear, Pillar 1 appears to have slowed. And so when he responds, I'd be grateful if the Minister could provide an update to the House on the progress towards the implementation of Pillar 1. We know, for instance, there is a great deal of work to be done to reach necessary agreement between all major economies, and so perhaps the Minister could confirm whether the government is still committed to Pillar 1 being implemented, and if so, what steps he has taken since taking up his role to help make that happen. Now, Madam Chair, whilst Clause 21 relates to making sure large multinationals pay their fair share of taxes, Clauses 31 to 34 deal with wider questions of tax avoidance and evasion. Now, we believe the government should make sure there are always tough prison terms and powerful deterrents for those who commit fraudulent tax evasion and other serious tax offences, and these punishments should be well publicised and effectively enforced. Likewise, we believe there is a strong case for tougher punishments for those who commit fraud against public services, government and the public purse. Other countries, indeed, have stronger laws and sanctions than the UK has for such offences, which mean that judges can hand down tougher punishments to criminals who have ripped off the taxpayer, such as willfully defrauding the country through public contracts or business support. Our new Clause 7 would require the government to be open and honest about what they are doing to prevent fraud involving taxpayers' money in terms of the measures in this bill, other measures more widely, and in comparison with the practices overseas. Those who defraud the taxpayer are stealing from the country, and it weakens our public services. We want to see fraudsters and organised crime gangs met with the full force of the law. As a country, we should have the most effective possible measures in place to prevent fraud involving taxpayers' money. Our amendment today will be the first step in making sure this is the case, and I would urge all MPs to join us in voting for it. Now, Madam Chair, in the legislation before us, we see the Conservatives trying to act tough by raising the maximum prison term for tax offences from 7 to 14 years. But the truth is that the government's own figures reveal that average sentences for tax frauds are just 2 years. Once again, they cannot hide from their record. They have failed to take tax fraud seriously, and any changes they make after 14 years in office are far too little, far too late. It is clear, Madam Chair, from an HMRC report which looks at the approach taken by their Fraud Investigation Service toward tax compliance and serious fraud in 2022-23, that the average length of custodial sentencing was 24 months. Now, we believe the public deserve much more information on how sentencing is working under the current government, and so our new Clause 2 requires data to be published setting out the average sentence, the range of sentences handed down each of the last 5 years for the offences that Clause 31 applies to. I would urge ministers to accept our new Clause 2, but if they are not willing to do so, perhaps they could confirm in their response if they will write to me with details of all the information that it requests. But whatever that data may show, Madam Chair, it seems clear from the data that is already available that under the Conservatives, sentences appear to be nowhere near the existing 7-year maximum, so 14 years seems an even more distant prospect. And the truth is that whatever the government may say about sentencing, our court system is already hamstrung by being neglected and facing the highest backlog on record, a backlog of 65,000 cases in the Crown Courts and over 350,000 in the Magistrates' Courts. We will not be opposing Clause 31, but this debate has made very clear just how deep the Conservatives' failure on law and order is and just what a mess they have created. Moving on, Madam Chair, to Clause 32 and Schedule 13, which would enable HMRC to bring disqualification action against directors of companies involved in promoting tax avoidance. Now, we support the principle behind this clause and we will not be opposing it. However, as the Chartered Institute for Taxation, and in particular the Low Income Tax Reform Group, have very helpfully pointed out, there are questions about making sure these powers are targeted and used correctly. These questions arise because of cases where the true promoters of tax avoidance schemes recruit others, often vulnerable or naive individuals, to be the directors of the companies involved and thereby shield themselves from any action. To be effective, the legislation needs to respond to this situation. On the one hand, the law needs to be able to pursue those ultimately responsible, whether they are the formal directors or not, and on the other hand, there needs to be a degree of discretion about the punishment on those recruited to be sham directors when they may be vulnerable people. On the first of these points, I understand the government is aware that those ultimately behind an avoidance scheme may not be directors themselves. The legislation seems to recognise this. Indeed, as the Low Income Tax Reforms Group has pointed out, the original draft legislation referred to directors, shadow directors and managers, which they felt covered the full range of people who may in fact be behind tax avoidance schemes. However, the Low Income Tax Reform Group has pointed out that whilst the legislation in fact before us it may include the reference to shadow directors, but the reference to managers seems to have been dropped. And so I'd be grateful if in his response the Minister could address that point and explain the rationale behind removing the reference to managers and whether that point needs to be reconsidered. In terms of the other side of this problem, those recruited to be sham directors, the Low Incomes Tax Reform Group have given powerful examples of where young or vulnerable people can be recruited without understanding what they are getting into. Whilst ignorance is not an excuse, it is reasonable for HMRC to make sure the consequences for vulnerable individuals who have unwittingly got involved are not unreasonably harsh. Furthermore, this is not only about protecting vulnerable people, it is also about making sure that the sham directors do not end up taking the fall for those behind the scheme, thereby letting the latter off being punished and indeed leaving them free to exploit a new round of vulnerable recruits. I would therefore be grateful if, in their response, the Minister could explain what processes and checks HMRC will be putting in place to identify vulnerable people, thereby making sure that any action against sham directors is appropriate for the individuals concerned. Furthermore, and very briefly, Madam Chair, we know there is a wider issue of bad faith actors setting up shell companies with fake directors and then using these shell companies for a range of purposes, including the practice sitting behind dodgy American-themed candy stores who avoid paying business rates. Now, we have been calling for tougher identity verification requirements for new companies. In the case of business rates, this would strengthen councils' ability to take enforcement action against those who do not pay their bills. Now, I realise this is beyond the strict scope of this debate, but I wonder when the Minister responds whether he could agree to write to me with details of what conversations he has had with the Secretary of State for Business about using powers in the Economic Crime Act to specify identity verification requirements for new companies with Companies House. Moving on to Clause 33, Madam Chair, which introduces a new strict liability criminal offence for failing to comply with a stop notice issued by HMRC in relation to a tax avoidance scheme. Now, in practice, this clause will escalate the punishment for failing to comply with a stop notice from its current position, which is penalties of up to £100,000 or £1 million in certain circumstances, to instead meaning the promoter has committed a criminal offence if they fail to comply with a stop notice without a reasonable excuse. We welcome firm action being taken against those promoting tax avoidance schemes. However, I would like to raise a point of concern that the Chartered Institute of Taxation has identified. As I understand, the Chartered Institute has made clear to HMRC, they are concerned that the decision to issue a stop notice and thereby determine that a criminal act may have been committed will rest entirely with HMRC with no external oversight. To make sure appropriate safeguards are in place, I understand the Chartered Institute has proposed that failure to comply with a stop notice should only be a criminal offence if judicial approval for the issue of the notice had been obtained first. Alternatively, at the very least, the Chartered Institute has made clear that HMRC's internal governance overseeing the issuing of stop notices must work effectively. Similarly, the ICAEW has proposed a number of safeguards, which I understand the government has said they won't consider, and the ICAEW has also suggested that such stop notices should only be issued through a decision taken at a higher level of seniority within HMRC than at present. Now, I understand that HMRC has said they do not support any of the range of safeguards proposed by these representative bodies, but HMRC has said they will be sharing a clear picture of their governance process in due course. So I'd be grateful if the Minister could confirm when this will happen and what checks and balances they expect this governance process to enshrine. Finally, Madam Chair, I will address Clause 34, which relates to the construction industry scheme and gross payment status. Now, under the construction industry scheme, we know that contractors make deductions from payments to subcontractors and they pass that money on to HMRC as an advance payment against the subcontractor's tax liabilities. We know a subcontractor can avoid this money being withheld by applying for gross payment status, and Clause 34 limits those subcontractors who can hold this status by excluding any who fail to meet VAT obligations and who are involved in various categories of tax fraud. We welcome the principle of this measure in setting out to penalise subcontractors who do not follow the rules on tax. However, we recognise the concern, raised again by the Chartered Institute of Taxation, that it could have a disproportionate effect on the cash flow and reputation of subcontractors if they were to lose gross payment status as a result of minor VAT compliance failures. We therefore welcome the fact that, as we understand it, draft regulations have been published to attempt to address this point, and I would welcome the Minister's further reassurances today that the Treasury will engage with the industry, including the Chartered Institute, to make sure these regulations are effective. Madam Chair, As I've made clear, we will not be opposing the clauses being considered in this debate, but I look forward to the Minister's response to the detailed questions I have raised in relation to them.
Richard Fuller.
Thank you very much indeed, Madam Chairman. Just a couple of points, if I may. On the issues of Pillar 2 and the moving forward of the government's policy on this in Clause 21 and Schedule 12, and that obviously relates to changing the decision makers on the taxation rates for multinationals operating in this country from the British government, elected by the British people, to an international organisation and their determinations through treaty. As we move forward, it's important to be aware of context and changing context, and honourable members on both sides, certainly on this side, have raised in the past the issue of who else is coming along for this particular minimum tax global party. We already know that one of the major economic actors in the world, China, is not part of the OECD, will not be complying with this, will not be part of these regulations. I'm interested in any update the Minister has on views about China on this. And second of all, it's clear that there will be an election in the United States later this year, and that there is a significant difference in opinion between the Republican Party and the Democrats about whether they will enact the USA's part in Pillar 1, particularly in Pillar 2, taxation policies. So given that there is a reasonable, some may say better than 50-50 chance, that there may be a change in administration in November this year, and the United States would then potentially withdraw from participation in the OECD process, can the Minister, in his summing up, give some reassurance to those of us on this side of the House, although always supportive of the Prime Minister, that may just want to make sure that we have clarity on what we would do in the eventuality that neither of the two major economies in the world, the United States nor China, are taking part in this particular global minimum tax from multinationals. I'd also be interested, and maybe not from the dispatch box, but maybe separately with the taxation minister, to understand in the Treasury and the HMRC, where is the definition of certain words moving when it comes to tax avoidance and tax evasion? Because I recall many years ago the clarity of the difference was that tax evasion was illegal and tax avoidance was within the law, but maybe not what HMRC wanted to happen. It wasn't the intention, but it was legal. But we see in the bill, the finance bill, there are references to tax avoidance that implies that it's illegal. And I just worry that we haven't got clarity, and there isn't sufficient clarity from HMRC's perspective on the difference between tax evasion, legal, and tax avoidance, tax evasion illegal, and tax avoidance legal but perhaps not desirable. And perhaps the Minister could just give some clarity on that, because he'll be aware, all the front bench will be aware in the Treasury, about the persistence of concerns about loan charge and other aspects of tax avoidance schemes, which the HMRC has then taken to court, won certain court actions, but then decided that they will blanket some solutions on cases where there've never been a finding of fact in a court on those particular schemes. And the question I have, the specific question I have on that is, and I hope this is within the scope, Madam Chairman, but if not, you'll tell me if not, is why haven't we brought the HMRC's approach on tackling loan charge to a conclusion? It has gone far too long. People have been pursued for far too long in an area that is far too grey for many people, and it would be interesting if the Minister have an update for that. And thirdly, can I commend the Shadow Minister? I didn't like his first speech in the first section today, but this I thought he was a very, very good speech, very reasonable. But he made a very important point, which I'm sure the government will want to look at, which is on the failure to comply notices and the requirements for, I think in the references that he was making, the third party has said for some sort of judicial reference before those failure to comply notices can be held out. At the moment, in the bill, It basically says the HMRC, undefined, can put out those failure to comply notices, and that really is quite a significant expansion, further expansion of the HMRC's responsibilities. And I think the Shadow Minister made a good point, or referred to a good point, when he said that this needed some more protection for those who might be caught by such notices. So I'm sure the front bench will always listen to points made on either side of the House, but I did think I would just commend that point from the Shadow front bench.
Sarah Olney.
Thank you very much, Madam Chair. I'll be speaking on new clauses 4 and 5 in my name. I'd like to reiterate the Liberal Democrats do not support this bill, which is a deception from the government after years of tax hikes on hard-working families. It arises from an autumn statement that contributed to a record fall in living standards by maintaining this government's stealth tax on working families through the freezing of income tax thresholds. Some of the measures under consideration today may have worthy aims, but that wider context must be noted. I firstly wish to speak to new clause 5, tabled in my name, which would require the government to produce an assessment of the impact of the bill's tax evasion and avoidance measures. Now, this assessment would specifically need to include a review of whether the staffing of the compliance functions of HMRC is sufficient in order to implement these new measures. This follows the revelation to me in a parliamentary question last year that almost 2,300 HM Revenue and Customs tax compliance staff are still working on matters relating to our exit from the European Union and COVID-19 schemes. And this means that thousands of staff who'd usually be working on recovering taxes or dealing with other issues are instead being redeployed to manage the government's mishandling of the pandemic and Brexit deal. It's alarming to see that civil servants are being moved from one crisis to another, and an indication of a government in non-stop firefighting mode. We've known for a long time that HMRC is an organisation beset by understaffing issues. Last year, the Institute of Chartered Accountants of England and Wales say that not only is this chronic understaffing causing unacceptable delays to businesses and families, it is hindering activity and actively hurting our economy. With that knowledge, can we have faith that HMRC will be properly equipped to put the measures in this bill into action? And while the measures contained in clauses 31 to 34 and Schedule 13 may have the worthy aims of combating tax avoidance and fraud, the knowledge of these shortcomings makes it very difficult to have confidence in the capacity for HMRC and in particular its compliance functions to effectively administer these measures. And I therefore urge the government to accept new clause 5, support the Liberal Democrats in ensuring that HMRC is fully equipped with sufficient staff to properly tackle tax avoidance. Secondly, I would like to speak to new clause 4, again tabled in my name, and this new clause concerns the bill's Pillar 2 measures contained in clause 21 and Schedule 12. It would require the government to produce an assessment of the impact of those measures, examining whether they have been successful in achieving their policy aims. As Liberal Democrats, we strongly believe in the need for a fair international system that tackles corporate tax avoidance and evasion for the benefit of all countries. We welcome the pioneering work that has taken place under the auspices of the OECD for the formation of a fairer international tax system. The measures in Clause 21 of the bill arise from that process and enable the UK's adoption of the Income Inclusion Rule and Domestic Minimum Top-Up Tax Rule. As such, they are to be welcomed. However, issues remain. Most crucially, we believe that the global minimum corporation tax rate set at 15% under the deal remains too low. Liberal Democrats have called on the government to help negotiate an increase to 21%, as originally proposed by the US under President Biden. Organisations such as Oxfam have highlighted that the 15% minimum rate still leaves many developing countries at a disadvantage, as they will continue to face unfair competition from tax havens. It's extremely disappointing to see the government's failure to back a rate of 21%, despite having raised UK corporation tax to 25%. Significant progress has been made, should not be obstructed or diluted. But if we are serious about pursuing the goal of a fairer global tax system, we must also take the time to ensure that the best path is being followed. Happy to give way.
And I understand the intent of what she's saying. Could you just explain, though, how this review could be done within 6 months of this Act being passed, given no business will have filed a tax return with any adjustments in until well after that period, and indeed half the world probably won't have introduced the measure by that stage? Isn't it going to be a little bit of a premature assessment? And wouldn't you we risk that assessment showing no progress and then sort of strengthening the arguments from those that would like to repeal it? I think this would probably be quite a bad assessment to do at this stage.
I welcome the honourable member's intervention, and dare I say, I completely agree with him. But of course, you know, one is constrained by what one can actually amend to legislation. But I'd like to see that as the start of an ongoing process, obviously of reviewing, because this is, let's be honest, it's an innovative proposal, not just in the fact of its being an international cooperative effort, but that very effort in itself being innovative, and is therefore something that we, as I dare say, a sovereign parliament, should be keeping very much under review as the work continues. Finally, I would also wish to briefly note that the Finance Bill has some implications for theatre tax relief, which plays a crucial role in enabling the development of new theatre productions in the UK. UK Theatre and the Society of London Theatre have raised concerns to the Treasury regarding these implications, which could damage how this essential relief operates. I therefore urge ministers to liaise with these groups to particularly provide assurance that international touring will not be hampered due to the Bill's definition of UK expenditure. And this is certainly an area that would benefit from scrutiny in the Public Bill Committee. To conclude, while the Liberal Democrats are supportive of certain measures within the bill, such as the extension of full expensing, the bill as a whole does not have our support, arising as it does from an unjust and deceptive autumn statement. I urge members to support the amendments tabled in my name, in particular new clause 5, which will hold the government to account to ensure that HMRC is properly resourced to allow it to carry out the measures in this bill. Thank you, Madam Chair.
Minister.
Well, Madam Chair, let me thank honourable members from across the House for their contributions today in this debate. I'm going to speak relatively quickly, but let me try to address some of the points that have been raised. I will deal with the new clauses that have been laid last, but in the meantime, let me address some of the questions from the honourable gentleman from the official opposition. He asked about Pillar 1 and the progress that is being made. I can tell him that this government fully supports Pillar 1. We're keen to maintain momentum on its progress as soon as possible, and he should take comfort from the recent publication of the substantially agreed text of the Multilateral Convention, which does demonstrate progress. But as I say, we are not complacent on that, and we are very keen to see progress happen as soon as possible. He very reasonably asked for more information on sentencing and the action that has been taken by HMRC. I can give him some data now. I can tell him that last year there were 240 prosecutions last year, and within that there are 218 convictions. 130 of those were custodial sentences and 110 were suspended sentences, and this equates to a 90% success rate for HMRC. He is right that the average length of a custodial sentence is 24 months. One of the reasons that we want to extend the maximum sentence is to do two things. One is to make it very clear that we find fraud and all fraudulent activity to be some of the most serious crime possible because of the impact on public finances. But in doing so, in increasing the maximum sentence, we expect all sentences to rise as sentences are judged relative to the maximum sentence. But I will stress that it is the Sentencing Council who issue and provide the guidance to judges, and it is judges and the courts who rightly decide ultimately what the sentences are provided to those who are found guilty. He asked about safeguards for stop notices. He's right to highlight that this is an important measure for HMRC. I'll tell him that there's been already 20 stop notices issued since HMRC started issuing them just a year ago. But there are robust governance processes and safeguards in place, including review and appeal rights. But again, as relates to a criminal sentence, it is decided by the courts, and it is the Sentencing Council who will decide on that. On the other points, I will look carefully at the questions he's raised and ask for a written response, and if we have that data, I will commit to writing to him with that information. My honourable friend for North East Bedfordshire
quite rightly and has consistently raised his questions and concerns on Pillar 2. I can tell him that the UK is implementing Pillar 2 in time and alongside EU member states, Japan and Canada, who are all, I think he would agree, our peers. He asked about China. China haven't announced implementation plans for Pillar 2, but I can tell him that they are a member of the inclusive framework of countries that are in negotiations right now on Pillar 2, and we are monitoring that very carefully, as he would expect. As relates to the United States, the US administration has always supported both Pillars 1 and 2 and have been one of the strongest advocates. As he will know, in 2017, the United States introduced their own domestic version of the Pillar 2, which is requiring those companies with foreign income to pay a minimum level of taxation. But I guess the punchline to answer the ultimate question he has is that already the agreement has been put in place to ensure that 90% of multinationals by 2025 will be in play, and so we are confident in the robustness of this agreement. He asked about the loan charge, which I don't believe is in scope for this debate today, but I will confirm to him that the Financial Secretary will follow up with him and engage both with him and the APPG in due course. Now, let me very briefly, Madam Chair, address the new clauses that have been laid down. New clauses 2, 5 and 7 I will deal with together, and then address new clause 4, as these all relate to tax avoidance and evasion. New clause 2 would require the Chancellor to provide a report on the average sentence and range of sentences given to offences being amended in clause 31, the number of stop notices that are issued that clause 33 would apply to, and the impact of these clauses on tax revenues. New clause 5 would require the Chancellor to carry out an assessment on the impact of clauses 31 to 34 and schedule 13 on HMRC's compliance activities, and new clause 7 would require the Chancellor to review the effectiveness of the provisions of clause 31 in combating fraud involving taxpayers' money. Let me say straight out the gate that I agree that it's important that we regularly review and evaluate policy. However, these new clauses are unnecessary, as HMRC already publishes detailed information about its compliance performance on a very regular basis. As I've said, the UK tax gap is already at an all-time low at 4.8% and will remain low and stable given the measures that we are implementing. As I say, every year HMRC publishes information on the number of custodial sentences received for tax compliance offences and the average sentence length in HMRC's annual report and accounts. The 2023 to 24 annual report and accounts will be published this summer, providing a full overview of HMRC's performance. So, Madam Chair, as most of this information is publicly available already in routine HMRC publications, the assessments legislated by these new clauses is unnecessary in our humble view. As relates to new clause 4, Madam Chair, new clause 4 would require the government to report an assessment of the technical changes to Pillar 2 introduced in clause 21 and Schedule 12, which should consider their impact on multinational profit shifting and tax competition between jurisdictions and the efficacy of technical changes. The government considers that such a report isn't necessary because the amendments being introduced in this finance bill are technical changes and that enhance Pillar 2 legislation, which received royal assent just last year. These amendments that simply help to ensure the policy objectives of this legislation are met fairly and effectively, reflecting both new international guidance and stakeholder comments. Ultimately, it's about avoiding unintended consequences of the legislation that has already been passed. Of course, the government will monitor Pillar 2's overall impact as businesses begin to respond to its implementation across the world, and there are 130 countries, of course, that are privy to it. So to conclude, Madam Chair, I hope that I've been able to reassure the members that the issues raised in new clauses 2, 4, 5, 7 today are additions that aren't necessary for the reasons that I've set out. I therefore urge the House to reject new clauses 2, 4 and 5 and 7, and for the reasons I've set out at the beginning of this debate, I beg to move that clauses 21, 31 to 34 and schedules 12 and 13 stand part of the bill.
Question is that clause 21 stand part of the bill. As many as are of that opinion say aye. Aye. Contrary, no. I think the ayes have it. The ayes have it. With the leave of the House, I shall put together the questions that Schedule 12 be the 12th schedule to the bill, and that clauses 31 and 32 stand part of the bill, that Schedule 13 be the 13th schedule to the bill, and that clauses 33 and 34 stand part of the bill. The question is that Schedule 12 be the 12th schedule to the bill, that clauses 31 and 32 stand part of the bill, that Schedule 13 be the 13th schedule to the bill, and that clauses 33 and 34 stand part of the bill. As many as are of that opinion say aye. Aye. The contrary, no. I think the ayes have it. The ayes have it. New clause 2 has been selected for separate decision. James Murray to move new clause 2 formally.
Review of measures to tackle evasion and avoidance.
The question is that new clause 2 be read a second time. As many as are of that opinion say aye. Aye. The contrary, no. No. Division, clear the lobby. The question is that new clause 2 be read a second time. As many as are of that opinion say aye. Contrary, no. No. Tellers for the ayes, Andrew Weston and Mary Glinden. Tellers for the noes, Mike Wood and Suzanne Webb.
The ayes to the right, 228. The noes to the left, 298.
Thank you. The ayes to the right, 228. The noes to the left, 298. So the noes have it, the noes have it. Unlock. New clause 5 has been selected for a separate decision. Sarah Olney to move new clause 5 formally.
Formally.
Tax compliance reporting.
The question is that new clause 5 be read a second time. As many as are of that opinion say aye. Aye. The contrary, no. No. Division, clear the lobby. The question is that new clause 5 be read a second time. You need to stop people. No, you need to stop people coming through. As many as are of that opinion say aye. Contrary, no. No. Tellers for the ayes, Jamie Stone and Richard Ford. Tellers for the noes, Mike Wood and Suzanne Webb. Order. Order.
The ayes to the right, 18. The noes to the left, 300.
Order. Order. The ayes to the right, 18. The noes to the left, 300. So the noes have it, the noes have it. Unlock. We now move to new clause 7, which has been selected for a separate decision. James Murray to move new clause 7 formally.
Review of effectiveness of section 31 measures in preventing fraud involving taxpayers' money.
The question is that new clause 7 be read a second time. As many as are of that opinion say aye.
Aye.
The contrary, no.
No.
Division, clear the lobby. That new clause 7 be read a second time. As many as are of that opinion say aye. Contrary, no. Tellers for the ayes, Andrew Weston and Mary Glinden. Tellers for the noes, Mike Wood and Suzanne Webb. Order. Order.
The ayes to the right, 222. The noes to the left, 301.
Thank you. The ayes to the right, 222. The noes to the left, 301. So the noes have it, unlock. We now come to Group 3, and we will begin with Clause 25 stand part, with which it will be convenient to consider Clause 27 stand part. The question is that Clause 25 stand part of the bill. I call Minister Nigel Huddleston.
Madam Chair, I'll now cover clauses 25 and 27. Taking clause 27 first, the changes made by clause 27 clarify how VAT and excise legislation should be interpreted in the light of changes made by the Retained EU Law Act, which came into effect on the 1st of January. That Act ends the supremacy and special status afforded to retained EU law in the UK. As was made clear when the Act was introduced, the Government is taking a bespoke approach in relation to UK VAT and excise law. In line with the Retained EU Law Act, this clause confirms that for VAT and excise, it will no longer be possible for any part of any UK Act of Parliament or domestic subordinate legislation to be quashed or disapplied on the basis that it is incompatible with EU law. In other words, it will no longer be possible for businesses to rely on EU law where it is in conflict with domestic law. The measure also provides that UK VAT and excise law continues to be interpreted as Parliament intended, drawing on rights and principles that currently apply in interpreting UK law. This legislation, which was subject to a provisional collection of Taxes Act resolution from the 1st of January, ensures the stability of the VAT and excise regimes and provides legal certainty for businesses following the changes in the Retained EU Law Act taking effect. It mitigates the risk of relitigating settled interpretation of UK law, protecting billions of pounds of Exchequer revenue. VAT and excise duty from alcohol, tobacco and hydrocarbon oil raise over £200 billion of revenue per year. That is a litigious area with the existing framework and precedents protecting large amounts of revenue. For example, in just 5 VAT cases, £5 billion of tax revenue was protected with the support of such precedents. VAT operates, of course, in real time, with VAT invoices and associated money being passed between businesses and other businesses or consumers on the basis of the law in place at that time. That means legal certainty is key. Businesses rely on this to ensure their tax affairs are correct, and HMRC also rely on it to collect tax. EU principles and rights will continue to apply solely, therefore, as aids to interpreting UK legislation, and any potential change in interpretation would create uncertainty for business. It could open up loopholes to be exploited by those looking to avoid paying their fair share, risking billions of pounds of Exchequer funds. Moving to clause 25, at Budget 2020, the Government announced that it would remove the entitlement to use rebated fuels from most sectors to help meet its climate change and air quality targets. Rebated fuels, such as red diesel and certain heavy oils, incur a lower rate of fuel duty. This is in contrast to petrol and diesel used by cars and other road vehicles that incur the full rate of fuel duty. As part of these reforms, the Government decided to continue to allow rebated heavy oils other than red diesel and bioblends made with red diesel to be used for all heating uses. This was due to concern that removing the entitlement to use these fuels for this purpose would significantly increase the heating bills of households and businesses that use them, especially in areas off the gas grid. However, as enacted, the Hydrocarbon Oil Duties Act 1979 prevents machines and appliances from using certain rebated heavy oils for commercial heating, including fuel oil, which is used in some commercial heating applications, including in furnaces. Since the Government's intention was to allow users of certain rebated heavy oil, therefore, to continue we wish to continue the use of rebated fuel for heating. Since this is the case, HMRC has been exercising its discretional collection and management powers to allow the use on this basis that the existing legislation, the assumption was that the existing legislation would then be changed at the earliest opportunity, and that's exactly what we're doing now. So this clause will amend the legislation, giving clarity to the dozen or so businesses affected by this anomaly, in line with the government's announced policy position. And I should make it clear that no consumers have been disadvantaged by this error. So, Madam Chair, these changes are necessary to provide legal certainty for business and ensure that the relevant regimes operate as intended, and I therefore commend clauses 25 and 27 to the committee.
Shadow Minister Tulipstein.
Thank you, Madam Chair. I rise to speak on the clauses relating to VAT and excise measures put forward for this afternoon's debate. I will begin by considering Clause 25, which restores a full tax rebate for machines and appliances using non-gas heavy oils and bioblends for commercial heating purposes. The government states that this is to correct an anomaly brought about by April 2022 changes to the Hydrocarbon Oil Duties Act 1979, which means that machines using kerosene have benefited from a full rebate, while those using other types of heavy oil were made ineligible for lower duty rates when used for heating. The government has stated that its April 2022 tax changes were intended to reduce the use of gas fuels and make progress against the UK's climate commitments. However, perversely, under the current system, companies receive a tax penalty for using next-generation renewable fuels such as hydro-treated vegetable oil for heating instead of kerosene, despite the fact HVO produces nearly 90% less greenhouse gas emissions. So I support the fact that Clause 25 seeks to correct this unintended error and restore equivalent tax treatment for the use of non-gas heavy fuels for commercial heating. However, let's be clear, the correction will have a limited impact for business across the UK facing rocketing heating bills as the cold starts to bite this winter. And we also know that it's often the scandalous lack of grid connections that forces many businesses, particularly in rural areas of Scotland, to operate their machines off-grid using heavy oils and biofuels. Changing tax incentives, while significant, will not deliver the overhaul our energy system needs to become a clean energy superpower. After 13 years of mismanagement, our energy grid is on its knees, with new developments forced to wait up to 15 years for a new connection and over £200 billion of privately funded energy projects stuck in limbo. We on this side of the House will prioritise reforming the grid, overseeing the largest upgrade to a national transmission infrastructure in a generation and accelerating connections for those who are forced off-grid. Because we cannot afford to keep dragging our feet on this any longer. While the government claims it is serious about delivering the transition and boosting the use of clean energy sources, the neglect of our grid infrastructure has been shocking. We know that the significant increase in both clean power generation and clean industry that the UK will need to reach net zero will require 4 times as much grid infrastructure in the next 7 years as has been built in the last 30. So while the opposition does not oppose Clause 25, which is a welcome correction, ensuring tax incentives for non-gas heavy fuels remain consistent is the bare minimum we should be expecting from the government on this vital issue. I will now move on to Clause 27, which seeks to clarify UK primacy on VAT and excise law following the passage of the retained EU law bill. The government's draft legislation seeks to ensure that in relation to VAT and excise law, it will no longer be possible for any UK Act of Parliament or domestic subordinate legislation to be quashed or disapplied on the basis that it was incompatible with retained EU law. The government states that this measure will ensure the stability of the VAT and excise regime, providing legal certainty for businesses. Labour is unsurprisingly supportive of the objective of this legislation, ensuring that firms have clarity over how the VAT and excise regimes should be interpreted following the UK's departure from the EU is crucial to retaining business confidence. However, following the government's public consultation on this draft legislation, which concluded in November, it remains entirely unclear that this measure achieves its stated objective of reducing the complexity for businesses of interpreting the VAT regime. In its consultation response, the Chartered Institution of Taxation highlighted a number of concerns about the proposals, pointing out that the significant complexity in interpreting this draft legislation risks undermining the certainty that it seeks to deliver. Specifically, the Chartered Institute of Taxation points out that the distinction drawn in the legislation between disapplication and the quashing of UK law as a result of EU law on one hand and interpretation on the other, I quote, might in practice be insufficient to achieve the desired result. Consultation feedback also pointed out that the draft measures contained in Clause 27 do not make it clear how far higher courts are intended to be bound by prior case law from the Court of Justice of the European Union, creating uncertainty for businesses and advisors. So while taking a bespoke UK approach to VAT and excise legislation is welcome in principle, the draft legislation also fails to address the fact that the removal of the reliance on EU provisions will create significant gaps in UK legislation where our domestic rulebook did not fully transpose EU directives. And it is not just tax experts that have sought to draw attention to this issue through the government's consultation. The industry body for the banking and finance sector, UK Finance, have warned over and over again that the draft legislation doesn't adequately address the complexity of the VAT landscape and risks, in their words, a high degree of uncertainty for industry and the prospect of settled interpretations of VAT law being disturbed. The trade body pointed out that while EU VAT law indicates a clear VAT exemption for intermediate services in connection with bank accounts, the exemption has not been implemented in UK law. With businesses no longer able to rely on the direct effects of EU law, material changes to VAT exemptions in the financial services sector will come into effect. While just one example from my own shadow brief, this highlights the additional uncertainty this clarifying draft legislation has already created for business. What is particularly concerning is that despite the clear message from tax experts and industry through the consultation problem that the proposals are at best problematic, government seems to have ignored this feedback and ploughed on with not a single amendment made to the draft legislation. Detailed guidance is needed, Madam Deputy Speaker, to address the significant issues that have been raised regarding Clause 27 and ensure that it meets its objectives. While on this side of the House, we will not oppose the measure as we remain supportive of it in principle, I do feel that urgent clarity is needed on a measure that will come into effect from the beginning of this year. The shock that a government measure designed to provide legal certainty and stability has raised more questions than it has answers has slightly worn off for us obliged to follow the circus on the opposite benches on a daily basis. So, Madam Deputy Speaker, to conclude, whereas we won't be opposing the two clauses in this debate, I feel that the detail of these proposals continue to raise questions about the competence of the government. From being able to afford low-carbon fuel and avoid crippling heating bills to having certainty over VAT regime, UK businesses deserve far better. After 13 years of leadership, we need a government that can provide the confidence that businesses so desperately need, using the clean energy sources of the future to drive growth and investment across the country.
Sir Mark Penning.
Well, thank you very much indeed, Dame Rosie, and it's a pleasure to have sat through the committee stage of the bill, and it's a pleasure also to hear the government talking about the advantages that we've got from Brexit. And clearly the government have looked extensively at the taxation system and continue to look extensively at taxation, and in particular, as this clause talks about interpretation of VAT. There is an interpretation of VAT in this country which it really massively affects people who are visually impaired, and also who, perhaps from dyslexia, can't read. There is no VAT on books, but the interpretation from the Treasury on VAT on audiobooks is 5%. Now, if this interpretation of VAT is going to be taken through as far as it possibly can be, I'm really disappointed that within this structure of this bill, we're not seeing disabled people being protected in a way that they haven't been for many, many years. I was told years ago when I was the Disabilities Minister this couldn't happen because we were inside the EU, and when we're not inside the EU, we can set our VAT rates at what we like them to be. And I think it would be fundamentally good of the government to come forward with interpretation of VAT to say that people that rely, for no fault of their own, on audio books don't have to be penalised with VAT at 5%. And it's just not the visually impaired, Madam Deputy Speaker, and I declare an interest. I'm dyslexic, so I also rely, not completely on audio books, but people that, for instance, can't read Braille are being punished as well. So while the government continues to look at new taxation rules and new ways of making sure that people don't get around the taxation system, it's clear that they are looking at the implementation of VAT, and what better way and a spring present to those that rely on audio books than the Minister to come forward and say he'll meet me perhaps and talk about it more, and perhaps even look at the EDM that's down in my name.
SNP spokesperson Drew Hendry.
Thank you, Madam Chair. The technical changes in clause 25 and 27 open up a lot of questions, and I have a point of agreement with the Labour front bench in that there are many questions on the operation that still have to be answered there. But there are wider questions for people on both of these clauses, which are inspired by the context of them. And before I get to them, I just want to point out that this finance bill is a stark reminder that Westminster governments never reflect the values of the people of Scotland. We need independence so that we can build a fair and dynamic economy that works for everyone. Here, whilst people suffer through the bitterest cost of living crisis, the provisions set out in the finance bill are nowhere near enough to help households in Scotland who've been left paying the price for disastrous decisions by Westminster governments, not least the harm of Brexit. No help for families struggling still with rocketing food prices. No help for mortgage payers, many seeing huge increases on their fixed rates deals just now. The cold is biting right now, and a week ago this Westminster government oversaw not the hoped-for help of the £400 energy bill rebate that we in the SNP called for, but another 5% hike courtesy of the price cap increase. Now, clause 25 is indeed righting a small wrong here. Those people living off the gas grid, though, deserve a lot more help than is being offered with this. They should have had the comfort of being in the regulation. They should be regulated under Ofgem, as imperfect as that organisation is. Indeed, I brought a 10-minute rule bill to this House to ask for that. And yet those people living off-grid are still suffering from a Wild West approach to pricing in terms of how they heat their homes. And that affects many people across my constituency and other large rural areas. They simply don't have a choice when the prices surge. This is a tiny measure that's being taken today, and more should have been done. I mentioned the £400 support. There should have been considered a social tariff. There should be reductions, not increases in the price cap to help people at this particular junction. Energy policy, as we know, is fully reserved to Westminster, and the Chancellor makes the decisions over whether or not people can afford to put the heat on. Well, a lot of folk cannot afford to put the heat on. In my constituency and across the Highlands and Islands, our region produces clean, cheap, renewable energy 6 times more than is needed by the people living there. The massive bulk of that production is exported to other parts of the nations of the UK, yet in return they get to pay higher standing charges in a climate that demands, and indeed higher unit prices, in a climate that demands they need to use more to make life bearable. We suffer the highest fuel poverty. Electricity charges in the Highlands are around 30% higher, according to Ofgem, than they are here in London. How is that fair? The Chancellor offered £1,000 a year off energy bills to those living near planned new power lines and generating equipment. So the question we now ask is, what about those already living next to and amongst that generation equipment? Why should they not be included? Why should they not be compensated in the same way? It must now be time, after the long years of this energy injustice, to right this wrong. The Chancellor must indeed establish a Highland energy rebate, and again, speed is of the essence. All of this and more should be done, but the fact is this place doesn't act on Scotland's needs. We have the energy, but we don't have the power. We should have that through independence. On clause 27, as highlighted in the notes of the bill, and indeed from the Minister's comments, we know that the Chancellor will raise over £200 billion a year in VAT and excise duty alone, a significant amount of that in the back of Scotland's food, whisky and Scotland's oil production. There, and now Labour and the Lib Dems Brexit was supposed to release them to support business. Instead, all it's brought is red tape and heartache. We see the results of that today in this debate. So let's see them step forward. Now, I'm not expecting the wild promises of Brexit that are no possibility of being delivered. But let's see if they can live up to them at a tiny amount in the form of some actions like a VAT cut for the tourism and hospitality sector, in the form of some support for disabled people. And I agree with the honourable member opposite. There should be more attention paid to that. The UK government's attempt to sell the tax measures set out in the statement as a giveaway for working people too is beyond belief. The Office of Budget Responsibility have been clear that the Chancellor's decision to freeze income tax will create 3.2 million extra taxpayers by 2028, with 2.6 million people more in higher tax bands. This is a Tory-made cost of living crisis, and the reality is that households in Scotland are paying the price for the UK government's mismanagement of the economy, with a especially devastating impact on vulnerable people. The stark difference between the UK government's autumn statement and consequently this bill and the Scottish government's budgets are that prioritises ensuring everyone in Scotland can have a decent standard of living is a timely reminder of why we need to get our own governance. In December, a report by UNICEF found that the UK's child poverty rates were amongst the highest in the world's richest countries. The report compared well-off countries' efforts to reduce child poverty, and the UK ranked as one of the worst performing when it came to tackling that, coming 37th out of the 39 nations of the EU and the OECD. Now, we also know that the cost of living crisis is also disproportionately impacting disabled people. So again, the call for a VAT cut is valid there, but there was nothing in the Chancellor's autumn statement in the Finance Bill that will do anything to make it easier for those with disabilities to get through this cost of living crisis. Indeed, the government actually seemed committed to making the lives of those with disabilities more difficult through a renewed focus on ramping up the use of cruel benefit sanctions. In October last year, research from Scope found that nearly 1 in 3 disabled people face debt. James Taylor, Executive Director of Strategy at Scope, noted, when disabled people are being pushed into debt and can't afford to eat, stay warm or shower, it's clear the system is broken. These figures lay bare the fact that disabled people are being hit hardest in this crisis, he continued. It is utterly shameful that the UK government has failed to bring forward measures in the autumn statement or indeed this finance bill that would improve the lives of millions of people who are facing poverty and in some cases now actual destitution. The fundamental problems with the autumn statement and this bill are what was omitted from it. I will give way.
And isn't this the problem? In the long term, this is going to cost more because if we don't invest in people's health and well-being, in the long term, it's going to cost the NHS, it's going to cost social services, it's going to cost even the DWP even more to support people as they continue to spiral down. And doesn't that contrast with the preventative approach that the Scottish Government takes with innovations like the baby box and the child payment?
And for that contribution, and of course he's absolutely right. The on-costs of not doing this do lead to further problems. Higher costs in terms of not only the cost of the public purse, but to the mental well-being and to the physical well-being of those people that are impacted by the cost of living crisis. These major fiscal events serve as a tangible example of the total mismatch, therefore, between the values of this UK government and the people of Scotland. The things this UK government choose to spend money on and the tax measures that they've chosen to leave out of the Finance Bill, such as abolishing non-dom status, are a clear reminder of this. It's abhorrent that at a time the same time as announcing cruel measures to force ill and disabled people into work, the UK government did not include any provisions on making the tax system fairer. There are countless examples of the UK government wasting money and then attempting to claw back these funds through targeting groups who are the least well off. The return to these draconian measures forced on ill and disabled people are just the latest example of this. The stark difference between the Finance Bill and the Scottish Government budget that prioritises ensuring everyone in Scotland can have a decent standard of living is a timely reminder of why indeed we need independence. The SNP believe building a strong economy starts with giving people a decent standard of living, and their most recent budget has reflected that, as my honourable colleague has mentioned. This Scottish Government's budget reflected the people of Scotland's shared values and speaks to the kind of Scotland we want to be. It's important to remember that the Scottish Government have achieved this against the backdrop of their very limited ability to raise additional revenue through taxes and having to work largely with a fixed budget. But despite these very difficult circumstances, the Scottish Government have once again shown their commitment to protecting our NHS from strikes as well as investing in it and shielding the most vulnerable people as far as possible from the impact of regressive Westminster policies. Whilst the Tories have just delivered a 3% real-term cuts to England's NHS in their autumn statement, the Scottish Government announced an increase to the frontline NHS budget in real terms. They also remain committed to helping those most impacted by the cost of living crisis. In their budget this last month, the Scottish Government increased the game-changing Scottish Child Payment in line with inflation to £26.70 a week, giving more support to over 323,000 under-16s who receive it. They maintained their commitment to invest £1 billion over the course of this Parliament to tackle the poverty-related attainment gap, with £200 million to be distributed in 24-25. They're committed to funding the £12 per hour real living wage for adult and children's social care and early learning and childcare workers in the private, voluntary and independent sectors who deliver funded provision. They've helped households through the cost of living crisis by making available an additional £144 million of funding to councils who agree to fully fund a council tax freeze in 24-25. The funding equivalent to supporting a 5% increase. These are just the latest measures the Scottish Government has taken to promote equality. The Scottish Government has, of course, introduced landmark policies to ensure that everyone in Scotland has access to a decent standard of living. If Westminster was in charge, Scotland would lose things like free university tuition, free school meals, free period products, free childcare for 3- and 4-year-olds as well as eligible 2-year-olds, free bus travel for the under-22s. All of this is possible because of the Scottish Government take a different approach to a budget to this place, and we need to make sure that we can do that in a much more effective way through the powers of independence.
Minister.
Thank you, Madam Chair. I think some honourable members may have tried to expand the debate here this evening to strictly beyond the scope of the measures for understandable reasons. I'll stick strictly to the clauses. My honourable friend, right honourable friend for Hemel Hempstead made some really important points about making sure that we take full advantage of the benefits of leaving the European Union. And of course, we've already made progress in this area, removing and replacing and improving retained EU law, including revoking all direct EU regulations in relation to customs duty and introducing a UK tariff and domestic customs regime, introduced in VAT relief for women's period products, VAT relief for the installation of energy-saving materials, and so on. The further points he made regarding potential future changes to VAT, of course, we always keep tax under review. He'll forgive me for not making tax policy at the dispatch box this evening. That's the purpose of key fiscal events, tempted as I am, but I will absolutely commit to meeting with my right honourable friend friend, always willing to listen and hear comments. With regard to further comments about, for example, encouraging the use of greener fuels, the government does encourage the use of renewable fuels through the Renewable Transport Fuel Obligation, which of course incentivises the use of low-carbon fuels and reduces emissions from fuel supplied for use in transport and non-road mobile machinery. On the point about the Court of Justice, of course, the EU Withdrawal Act 2018 provides that CGEU judgments issued since the end of the implementation period are not binding on UK courts. And on the point about codifying everything, of course, trying to codify all interpretive effects into black and white UK law would be a huge endeavour and would require a complete review of all that legislation, taking many years, and still leave significant tax revenue at risk. I therefore move that Clause 25 and 27 stand part of the bill.
The question is that Clause 25 stand part of the bill. As many as are of that opinion say aye. Aye. Contrary, no. I think the ayes have it. The ayes have it. The question is that Clause 27 stand part of the bill. As many as are of that opinion say aye. Aye. The contrary, no. I think the ayes have it. The ayes have it. That concludes proceedings in committee.
I beg to report that the committee has gone through the bill so as far as committed to it and made no amendment.
Yeah.
Clauses and schedules reported to lie upon the table. Thank you.
Right, we're now going to come to the next item of business.